Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, January 11th, and then we'll see how things look for Thursday, January 12th. We had kind of a surprisingly positive day. Usually, a day before a major economic report, because we have CPI coming out on Thursday, the markets tend to be rather subdued. We did see a decrease in volume, but we saw some more positive action, and that has really been able to change our technical picture over to a more positive look. However, we're getting more short-term extended to the upside. Even some intermediate term indicators are starting to get extreme positive, and we have some pretty hefty overhead resistance above where we're at. So we'll have to see how Thursday plays out. And I have a lot to talk about with that. But first, let's talk about Wednesday. Right at the open, we had a gap higher. The futures were fairly positive during the night, and we gapped all the way up above R1 at 39.34. As the day went on, prices fell back, which is very common. Then they climbed back up all the way to R2 at 39.48, and then we closed slightly below the 39.70 level. We did not get all the way up to R3, which was at 39.91. I had it calculated and ready to go, but we never got that high in the session. We were up 1.28% on average volume. So that did taper off just a little bit from Wednesday's session. The technicals are turning a lot more positive, but as I said, we're getting a little overextended because we're coming out of a trendless type of environment. But our ADX is looking a little bit better, and I'll show you that. And this all has to do with inflation and interest rates. And this is going to be a really big day on Thursday with the CPI coming out. Here is the intraday chart where we gapped up above R1. We kind of chopped sideways, fell back a little bit below R1. We're able to rebound and get all the way up to R2. That acted as resistance for a while, but then we actually broke above it. Then it acted as support. And then we saw some strength going into the close with a real nice green bar, giving us a pretty healthy advance for the day. So what are some comments we can make? The S&P, it's still above its 50-day moving average, which is at about 39.08. And that's the simple moving average. And that's what a lot of investors and institutions and program trading systems, they use that. And we also closed above 39.50, which is not necessarily all that important technically. The more times we bounce off that, it becomes technically important, but it's more of a psychological level. The markets are really anticipating the CPI coming out, and they're hoping that inflation will continue to fall, or disinflation. It's still at a very high level, but they're hoping that it will come down. What in the world is going to happen if this report comes in stronger than expected? That could really spook the markets. So you can't help but think, are we dealing with one of these situations where we're buying the rumor, we're running up the price before the news comes out, and then once the news hits, we then sell and we see a real crash after that, or a real decline after that? Always have to keep that in the back of our mind, because a lot of people are just thinking that, we'll just wait until the report comes out and react to that. Well, the market's been getting more and more positive running up to that. We see that in earnings reports quite a bit. A company will come out, have a really good earnings report, and then sell off right after that happens. Is that what's happening right here? We could get initial, if the report's friendly, it could go up to that resistance level and then turn down and go from there. So we're going to be really watching. Can we get above these resistance areas, stay above them, and then close above them? Then on Friday, we're going to be getting a lot of earnings reports from banks. So there's a lot of anticipation for that. And there's still this overhead resistance. We have the 200-day simple moving average, which is at about 39.87, not too far from the 4,000 level. And we have that downtrend line at about the 4,000 level, and they loom above the current prices. And I have a chart to show you that. The VIX is still acting kind of strange. We're trying to decide, is this going to produce some kind of change in trend as it continues to fall in that one chart that I show you, or are we going to do what has happened a lot lately, where it's given support to prices to actually move higher? Another thing that was kind of strange is the VIX actually was up on an up day. They tend to move in opposite directions, but the VIX has been acting kind of strange, but this probably indicates that there was a lot of hedging going on before the CPI release, because the smart money knows it's just a crapshoot right now. We could go up or we could go down from here, and the market's been spooked so many times in the last year. People don't want to get caught on the wrong side, and if they are on the wrong side, they want to hedge against those losses. The dollar declined and interest rates were down, so that did give some support to stock prices. And copper, at least on a one-day basis, is really starting to surge up. It's a little early to tell. We want to see more trends, just not necessarily a blip up or a blip down, but I do have a chart to show you. On a short-term basis, we still have the stochastics, the Stoch RSI, and the Williams percent R. Those were in yesterday's video, and they're still extreme positive. We're seeing the list a little bit longer with the CCI 14 as well as the 20 period is getting extreme. I don't have that on here. The moving average studies and our McClellan oscillator starting to get extreme positive. Again, it doesn't mean we have to stop here. It just means that we're going up a little too far, too fast, especially out of this sideways range that we've been in. So it doesn't take very much for us to become either overbought or oversold. And even on a long-term basis, our moving average studies, and I have a chart to show you that, we're starting to get a little more extreme. We still have the 30 to the 5-year that is more normal now, but the 10 to the 5, the 10 to the 2, and the 10 to the 3-month, those yield curves remain inverted. And the 10 to the 3 months even becoming more inverted. The lines it's really going down a lot more. I don't have a chart to show you that, but if it continues to fall, I'll be sure to bring up a chart of that in a future video. Sentiment is around neutral, and I'm going to start putting the numbers on here. This is a scale between 0 and 100. We're at 54 right now, so that's neutral land. And we only had the weekly MBA mortgage applications index that came out, and it was up 1.2% from the previous week. The last time we had this report, it was down 13.2%, so some improvement there. Our trend is positive, and we're just getting a little bit above the moving average, so it's getting a little bit stronger, but we're still below 20. Those of you that are a little more aggressive with the ADX, you like it when it crosses above the moving average, and you're willing to count that as a trend. Others that are more conservative, you want to see that line come back and possibly even get back above 20 before you think that we are actually in a trending environment. Our bias is positive with the up day, and I've kept our momentum positive as well. Now, if we have a real strong down day, something happens that spooks the markets, we could lose all of this positive backdrop right now. But for right now, things are showing some improvement. One thing that I've been showing is we're watching this white line here, and this just shows how the earnings per share have been decreasing throughout 2022. This hasn't been updated since the end of December, but these don't update all that much. Also, I've taken out that other chart that measures between 2006 and 2008. Now, this goes from 1998 into 2002, where this was the whole dot-com rise, and then here's the dot-com bust, and then we had 9/11 happen after that. The market seems to be following the same basic pattern. Will it continue? If it does, the white line's going down, and that might suggest that the yellow line will go down. Or are we going to break above this and get away from following this basic price pattern? Another thing that came out that feeds into sentiment is investors' intelligence, where we had been down at a pretty extreme negative reading, and that's when we use it as a contrary indicator. But we were down here a number of times in 2022, and it produced some bouncing, but it didn't really change the overall trend. But it's still giving us a pretty negative reading. So we're still kind of leaning more towards the contrarian indicator that this might be marking some kind of a bottom. Here is the VIX to S&P correlation, where the red lines just show when we spiked up and came back down. You can see what the S&P tended to do after that. Well, we spiked up and we're coming back down. We still don't really know if this is a valid spike. It looks like it could be. So what will happen now? Will that really push the S&P up higher, or are we going to see an actual change in trend as this continues to fall, and maybe the S&P 500 will fall as well? We really don't know at this point. The Ulcer Index is also leaning more towards the neutral side since it's below the moving average. As this goes up, that just means fear is increasing. When this is coming down, that means greed, or we're turning more positive. Here's the equity put call ratio. Not really surprising. Even on an up day, this ticked up on the daily chart, but it's still going down on the 5-period chart overall. And we're looking at this spike right now, which is just a massive move up to the upside. And here's the longer term look where we spiked up and now we're starting to come down. We're below this red line. A lot of times when we spike up, and that will often mark a bottom in the S&P 500. Is that going to happen this time? But we're not really seeing, if you go back to this chart, when we gave that really big spike, we were chopping sideways. We're not seeing a lot of climactic price action or critical mass at this point. Is that going to matter? If things do turn more positive, okay, we just built a base right here before we got ready to go higher, instead of having this washout type of scenario that developed. And then the ADX, you see it's just getting a little bit above the moving average. So you might consider that to be the start of a trend. It would be a positive trend because the green line is on top. If you're a little more conservative, you want to see this go back up and possibly get back above this blue line, which is at 20. The moving average study getting a little extreme with our 20, just a little bit under the extreme area with the 50, and showing some improvement with the 200. The stochastics, these are pretty touchy. And remember, these are subdivisions of the short term. So this top chart is short term. We're getting extreme positive. The intermediate short term starting to get extreme. And we're showing some improvement in the long short term view. Stoch RSI still camped near the top. Williams percent R also extreme positive. The CCI 14 has been extreme positive for a few days. The CCI 20 is just starting to come into extreme positive territory. The vortex is switched over positive with the green line on top and the red line on bottom. The green line's going up and the red line's going down. So that's more positive. Here's all of our oscillators. The short-term ones have already switched over positive. The intermediate term ones, some of them have already crossed over. Some of them are getting ready to cross. And our longer-term oscillators are starting to show some improvement. So we're seeing a lot of positive backdrop here with our indicators. Here's the PMO. The nice thing about this, it did cross over positive, but we were told about this a few days before it happened by the price and volume indicators down below. But then we look deeper into the PMO, and those PMOs that are rising, starting to get a little extreme positive, but we're showing improvements with the buy signals and those PMOs that are above zero. The BPI above 50 and advancing and not extreme. So this is positive. Here's the daily chart where we still have the 200-day moving average above where we're at right now. And then we have this declining trend line because we came up to this level multiple times in 2022, only to have that level rejected. So that would be a pretty big deal if we can break this downward sloping trend line. But we have to get above it, stay above it, and then close above it. And then down at the bottom, you see where volume was just about average. The balance of power is positive. The Swindlen Trading Oscillator based on price and volume are positive and not extreme. We're coming back up to the 200-day moving averages, both the exponential and the simple. That really provided resistance before. Is that going to happen this time if we even get up to that level? Here's the CMB Composite Index. And I added these lines on here because as I was looking at this chart, when we get extreme readings, I didn't include this on our list, but this often marks kind of an extreme positive reading right now. This is how far away we are from the 200-day simple moving average. We're getting back close to that level. Then the McClellan Oscillator, positive and still could go further, but starting to look a little extreme. The Summation Index based on price and volume, both are above zero and both are advancing. New highs, new lows also continue to show improvement. And the advanced decline line, haven't shown this in a while. We're seeing a lot more positive action with the price version of this indicator. We're coming right back up to a declining moving average with the volume measurement. Can we break through with volume and eventually see this red line turn back up? The advanced decline ratio, both the green, my goodness, the blue and the red are going up, and they're above zero and looking positive and not necessarily extreme yet. Here's our short-term fib level going from the August high to the October low, as well as the September high to the October low. We've been able to break above some of these resistance levels as we've been going back up. If we do continue to go up, we have another short-term resistance level at about the 4,006 level. And then longer term, we have another resistance level at about the 4,020 level. Here's our longer term moving average study, getting extreme with the 50, 150, and showing improvement and not extreme yet with the 200. The Copic curve is giving us a buy signal. The praying bottom fisher also crossed over, and that could be considered a buy signal. The staples to the S&P 500, this continues to decline, so this looks like it might be a valid spike, and it's been coming back down. If you look at other times when that happened, that marked a low in the S&P. But there's been other times when we've had these spikes and went, oh yeah, here we go. This is it. This is it. All I've done for 2022 is I just moved this question mark from here all the way over to here because we're not really sure at the time. We really only know this in hindsight. We just kind of have to guess right now, but we're also seeing a lot of other positive setups. This is a new chart. One thing that I've been studying, I took some extra time over the holidays to kind of look at how do home builders really affect the market. Well, and I spent some time drawing some pretty little circles and colors and things here. I'm going to take a few minutes and just kind of explain this. This goes back right to the end of 2021 into the beginning of 2022, when the S&P was making a higher high, and that ended up being the all-time high. Well, if you look at the home builders ETF, it was not making a higher high. So that's a negative divergence. And then after that, the S&P fell, and so did the home builder ETF. We were also seeing a negative divergence with the ratio between home builders and the S&P 500. So that was a warning sign, and to see weakness after that based on this is not necessarily a surprise. Okay, then we tried in early spring to have a nice little bounce up, and the S&P was going up. But look at the negative divergence. The home builders ETF was going down, and the ratio was also going down. All right, so that produced some weakness after we fizzled out that nice bounce. Then we kind of floundered around here. Well, then we had another upward move where we were going up with the S&P. The home builders were also going up, and they topped at just about the same time. We didn't really get much from the ratio because they were both going up together. But if you look down at the bottom, this is the correlation. When we're way up here near the top, that means they're going in the same basic direction. The closer we get to one, the closer they're going in the same direction. When we drop down below this line, that means they're having a tendency to go in opposite directions. And that's what I marked in yellow. Sometimes this can be significant to us, where we saw a real divergence here hitting this yellow mark, and that was as we were going up when the S&P was really advancing. And then we're working off of that right now. And what I'm trying to work my way over to the right-hand side of the chart. Earlier in November and in December, we saw where the S&P was making a double top here. Well, that was a negative divergence with the home builder ETF. Then after that, while the market has been going sideways, chopping sideways to slightly higher through a lot of December and into early January, look at what the home builder ETF was doing. It was really starting to go up. And so this ratio was starting to go up, and we were coming off of this yellow signal. So right now you could take this as positive. And so we want to keep an eye on this and see if this is a useful tool for us to use, because sometimes it gives us different signals. Sometimes it's really not all that beneficial. But right now, with this really going up the way it is, it looks like it could be a valid signal and it could be positive. But as with anything, this can stop at any time. We're just looking at how things are right now. Then copper, we spiked up in Wednesday's session, and we want to see, can that really continue? Because they call it Dr. Copper. If copper's trending higher, that means better economic times. If we're going lower, that means worse economic times. And we just spiked up right here, but we're still in an overall downtrend with the blue line below the red line. But if this stays above both of these moving averages, we could get a golden cross here, and that might suggest better days ahead for the economy. So then what's our outlook for Thursday? The technicals are turning positive, but we have to see follow through buying. It can't be like 2020 after the COVID plunge and into 2021 where you just buy the dips, buy the dips. I've never been a real fan of that anyway, because you could have 10 positions that you have where you bought the dip. And if that 10th one doesn't work out, you've lost everything at that point. And people aren't using real tools. They're just going by their gut feelings. Well, that's gambling at that point. So we have to see follow through buying. We're in a very challenging environment right now where just thinking something is going to go up or down or a gut feeling, people have been using that in 2022 and look how all that turned out. So that's why I really rely heavily on technical analysis. But if we see that follow through buying, we do have overhead resistance. We're becoming short-term overbought and slightly intermediate term overbought. So what's our out? Whoops, I thought there was more in here. Yeah, economic reports. We have CPI. That's the biggie that's coming out. Jobless claims will be coming out in the Treasury budget. And then it's inflation and interest rates and the CPI. That's the big news for right now. Then I started doing this in yesterday's video. I'm just going to go through this top part, and I'm thinking of flipping this chart upside down, where I start here with the yearly. I'm thinking of starting it with the daily, because this will not change. Where right now we're trying to decide, is the January barometer, will it be positive? Well, we have to wait until the end of January. However January ends, the market has followed whether it's up or down, 83.3% of the time, going back to 1950. Right now, we have a 2-0 score, where the Santa Claus rally, that was up, so that gave us a score of 1. The first 5 trading days were up, so that gave us a score of 2. And now we're waiting until the end of January to get score number 3. Will it be a 3-0 or a 2-1 type of scenario? When all 3 indicators were positive, the next 11 months were up 87.1% of the time and gave us gains of about 12.3%. If you look at the full 12 months, they were up over 90% of the time with an average gain of 17.5%. That's why we want to follow this. Also, the market likes that we have a mixed government. We have a Democratic president and we have Congress split between the Republicans and Democrats. And at least for the Dow, this has produced pretty good gains going back to 1949. And we have just different folks here. For the quarter, we're coming into the end of this quarter, November, December, January. This is usually the best 3-month span of the year. Now, November and December, they really sucked. But let's see if maybe January can help us out. Or is it going to end up sucking like the other months did? And then going back to the year 2000, we've been up 43.48% of the year, and we've declined 56.52% of the time. And then this is the one that's going to change every day. And that's why I'm thinking of flipping this around. For January 12th, nothing really monstrous here. In fact, we're below 50%. Where they get excited about this is when we have a success rate or upward movement rate of about 60% or more. Well, here it's under 50%, so that's neutral to negative. The same thing with the S&P, up 47.7% on every January 12th. The NASDAQ has fared a little bit better, so it's slightly more positive. So overall, I would take this more as neutral right now. So our scenarios can't really go with the down one right now because things are looking like they're really improving. The technicals are really turning positive. Unless you're really aggressive and you see confirmation and price movement, it's hard to go with the up one right now because our ADX is still under 20, but it is getting stronger. But the picture is improving. And if the ADX can continue to go up and we see follow through price action, we could switch over to a positive scenario at some point. So our conclusion, the S&P, it's turning positive after being more negative. Short term, we're positive, but becoming more overbought. Intermediate term, turning positive, and just a few overbought or extreme positive readings. But we're still negative in the long term because we are below the 200-day simple moving average. Thank you. Have a wonderful day on Thursday. This is actually take 2 of the video because I had some microphone problems and I forgot to check things. And I hope you found this new chart useful. Feel free to give me any feedback as you so desire. Have a great day, and I will talk to you in the next video.